For decades, MGM Resorts was more than just a name on the Las Vegas skyline. It was a symbol of the city's relentless ambition and dazzling allure. The company's towering presence helped shape the very identity of the Strip, drawing millions of visitors from around the world who came seeking excitement, luxury, and the promise of fortune. Its legendary properties, like the Bellagio with its iconic fountains and the sprawling MGM Grand, weren't just places to gamble. They were destinations in their own right, representing the pinnacle of entertainment, hospitality, and excess. These resorts set the standard for what Las Vegas could be, blending spectacle with sophistication. But as November 2025 arrives, the Golden Lion's roar is growing faint. The once bright lights that defined MGM's empire now flicker with uncertainty, hinting at deeper troubles beneath the surface. Economic headwinds, shifting consumer habits, and a series of strategic missteps have left this Las Vegas giant staggering. The city that never sleeps is watching one of its titans struggle to keep pace with a rapidly changing world. Once bustling casino floors now echo with uncertainty as the crowds thin and the energy wanes. Discounted room rates flood travel sites, a stark contrast to the days when every room was booked and every table was full. MGM's dominance, once assured by its storied legacy, is no longer a given. The company faces a slow but steady erosion of its strength. The warning signs are everywhere: deserted corridors, anxious investors scrutinizing financial reports, and empty chairs around gaming tables that once buzzed with life. Behind the scenes, a brand that once defined Las Vegas is now fighting to stay relevant in a market that's evolving faster than ever before. Marketing teams scramble for fresh ideas, hoping to recapture the magic that made MGM a household name. MGM, once the architect of modern Vegas, now finds itself in a desperate struggle to redefine its future. Executives pore over blueprints and business plans, searching for a path forward in a landscape filled with new competitors and shifting trends. If a titan like MGM can falter, it raises a sobering question: what does that mean for the rest of Las Vegas? The city's future may depend on how its giants adapt, or fail to adapt, to a new era. The numbers paint a grim picture. Las Vegas, once a symbol of endless opportunity and glitzy success, is now facing a harsh new reality. The city's bright lights can't hide the troubling trends lurking beneath the surface. Las Vegas hotel rates have dropped 12% year over year. MGM's own rates are down 11%. Fewer tourists are filling the iconic Strip, and the once bustling lobbies now echo with uncertainty. The city's lifeblood, its visitors, are simply not returning in the numbers needed to sustain the empire. Beneath these falling rates lies a mountain of debt, $32 billion against a market cap of just $9.8 billion. This staggering imbalance is a warning sign, one that threatens the very core of MGM's financial stability. This crushing debt limits MGM's ability to innovate or weather further storms. Every dollar owed is a dollar that can't be invested in new attractions, technology, or guest experiences. The company is forced to make tough choices, often sacrificing long-term growth for short-term survival. The company's stock, once over $50, now hovers around $34, reflecting deep investor skepticism. Wall Street is watching closely, and confidence is slipping away as the numbers continue to slide. MGM's history is one of vulnerability. Its stock collapsed 98% in 2008 and 79% in 2020. Each crisis has left scars, and the company has struggled to fully recover, always seeming to teeter on the edge of another downturn. Even BetMGM's online growth is a drop in the ocean compared to the debt burden. While digital gambling offers hope, it's not enough to offset the massive liabilities weighing down the company's future. A $2 billion stock buyback looks more like desperation than confidence. Instead of signaling strength, it raises questions about whether MGM is simply trying to prop up its share price in the face of mounting challenges. MGM is a kingdom built on shaky ground, heavily indebted, with shrinking margins and falling revenues. The once mighty empire is now struggling to maintain its footing as the world changes around it. The foundation is cracking and the world is watching. As the pressure mounts, the question remains: can MGM find a way to rebuild, or will this kingdom finally crumble under the weight of its own ambition? MGM's recent withdrawal from the New York casino license race sent shockwaves through the entire industry. For a company of MGM's stature, this was a public admission of weakness and uncertainty. Building a New York casino would require billions, money MGM simply doesn't have right now. Rivals like Wynn and Resorts World pressed forward with their ambitious plans, while MGM folded before the final cards were even dealt. This retreat marks a shift from bold expansion to defensive survival for MGM. MGM is no longer conquering new markets, it's fighting to protect what remains of its empire. The decision cedes a massive opportunity to competitors in the region, and damages MGM's reputation as an industry leader in gaming. The King of Las Vegas is now in quiet, uncertain retreat. As MGM retreats from the high-stakes battlefield of the Las Vegas Strip, recalibrating its strategy and pulling back on its most ambitious projects, Wynn Resorts charges forward with a jaw-dropping $10.5 billion bet on a new ultra-luxury casino, one of the boldest moves in Vegas history. This isn't just another expansion, it's a declaration of war in the battle for Vegas supremacy, a direct challenge to the established order. Wynn's vision is clear: seize the crown from MGM and redefine what luxury means in Las Vegas, setting a new standard for opulence and exclusivity. The strategy: build a property so lavish, so meticulously designed, that it transcends market trends and becomes a destination in itself. Wynn is targeting the world's elite, high rollers and luxury seekers willing to pay any price for an unforgettable experience. While MGM slashes rates to fill rooms, Wynn doubles down on exclusivity, creating spaces so rarefied that only the most discerning guests will ever see them. The bet is simple: even in a downturn, true luxury will always have its audience, and those who crave the best will keep coming back. It's a classic counter-cyclical move, investing big when rivals are pulling back, building when others hesitate. Wynn is betting that by the time competitors recover, it will have already captured the market's most lucrative segment. Wynn's brand has always stood for quality over quantity, for experiences that linger in memory long after the trip ends. This new project is the boldest expression of that philosophy yet, a resort designed to dazzle, to inspire awe, and to set a new benchmark for the industry. The company is making a statement: the future of Vegas belongs to those who dare to be the best, not just the biggest. It's a high-risk, high-reward play that could either cement Wynn's dominance for decades to come, or become a cautionary tale of ambition outpacing reality, a reminder of how quickly fortunes can change in Las Vegas. The stakes have never been higher, and the world is watching to see if Wynn's audacious gamble will pay off. Wynn's $10.5 billion gamble is bold, but is it wise? The broader Vegas market is in decline, with rates and demand falling. Wynn's bet assumes the ultra-luxury segment is immune to downturns, but even high-end rates dropped 9% last quarter. The project depends on a steady stream of international high rollers, an unpredictable, volatile market. Any global shock could leave Wynn with a costly, underperforming asset, the risk overextending on a single specialized project, just as MGM did with debt-fueled expansion. If the market doesn't respond, Wynn could face the same fate as its rival: massive losses and a strained balance sheet. The house of cards could tumble, and the consequences would be severe. Wynn's boldness may be its undoing. The Vegas crisis has forced MGM and Wynn onto radically different paths. MGM, weighed down by debt, is in damage control, cutting rates, buying back stock, and retreating from new markets. Its focus is survival, not growth. Wynn, meanwhile, is on the offensive, investing in luxury, holding prices, and bidding for new opportunities. While MGM flees New York, Wynn sees it as a chance to expand. Early results favor Wynn. Its luxury focus has insulated it from the worst of the downturn, while MGM's earnings continue to slide. But the long-term outcome is uncertain. MGM's diverse portfolio could rebound if mass-market tourism returns. Wynn's fate is tied to the high-end segment. If its bet fails, the fall could be spectacular. Two titans, two strategies, the future of Vegas hangs in the balance. The rivalry between MGM and Wynn is more than corporate drama, it's a battle for the soul of Las Vegas. MGM's decline signals the possible end of mass-market dominance, while Wynn's vision points to an exclusive, elite future. If Wynn's gamble succeeds, Vegas could become a playground for the wealthy, leaving the average visitor behind. But if both strategies fail, the city faces a deep crisis, questioning the very viability of the mega-resort model. The Strip's lights could dim, and Vegas could enter a period of stagnation and decline. The next few years will decide whether Vegas remains accessible to all or becomes a gilded enclave. The outcome will shape not just these two giants, but the entire city's future. What happens in Vegas now will echo far beyond the Strip.